Our guest now is somebody I haven't spoken to this year just yet. Warren Ingram, a financial advisor at Galileo Capital. Warren, happy 2019.
Thank you so much, Ray, and to you.
Thanks. Now listen, talking about investment and what investors should know this year, it's very important. I like your first point you have here. This too shall pass.
Yeah, I think it's kind of human behavior that we are most influenced by what's happened in stock markets in the last year. So when it's been a great year, we expect that it's going to be a great year again next year. And when it's been a lousy year, like 2018 was, then we become pessimistic and we say, well, that's what's going to happen in the next year. And I think, unfortunately, the last year is a terrible predictor to what's going to happen in the year ahead. You can't predict that after a big drop or kind of a smallish drop, that the market will bounce simply because it went down, and at the same time, when it has fallen, you can't predict that it's going to carry on falling. In fact, what you've got to do is almost ignore what happened last year and kind of reset the clock and say, okay, let's look at fundamentals, let's look at much more kind of rational factors to determine what we want to do with our money. But looking at last year and saying, that's what's going to be for next year, I'm afraid that's just not the case.
Yeah. I mean, looking today, the oil share hitting around about 53,000. I sort of thought to myself, this is looking better. You never know. It could be a great year.
Exactly. And I think, and that's the whole point is, we get so pessimistic, I think, in South Africa, or we go the other extreme where we become so incredibly optimistic. And I think always, try and kind of put aside the emotions when you look at investments and setting your expectations and try and let your rational brain kick in and make long-term decisions based on real fundamental thoughts and don't get too sucked into prediction. I think one of the things that we hear commentators talking about all the time is the elections will have a big impact, and don't get too worried about the elections because there'll be lots of rhetoric, and after elections, this or that will happen. And to my view, it's a prediction based on a few months' time, and I just don't think that has any merit on a long-term investment decision.
All right, talking expectations for investors for this year, your second point, equities and listed property are still your best choice for growth.
Yeah, so quite a nice controversial point. If you look at the JSE, it lost 8.5%, and that kind of caps a really terrible 5-year period where investors have received growth that's below inflation per year for a 5-year period from the stock market. Very unusual. A lot of investors are starting to lose faith in the stock market as a whole in South Africa and saying, isn't there a better place like a really big mattress where I can hide all my money? And then you add the impact of the listed property sector. Those are property companies that trade on the stock exchange. They lost a quarter of their value last year. And here's this crazy guy on the radio saying that those are still your best places to get long-term capital growth, but that's exactly what I'm saying. Because, if you look at a 10-year period, including last year as a really lousy year, shares in listed property have given you a growth rate of more than 12% a year. And really that's my point is you need to look at the long term and say to yourself, okay, so it's been lousy for a share investor for 5 years, and the listed property sector last year was really terrible.
Yeah.
But these are the sectors that give us the long term growth. And if you're looking to get inflation plus growth from your investments, then you need to take the risk and you need to take the knocks that come with those two sectors, but that's the place to be to get your long-term growth.
Yeah, long-term. That means don't cash it in now, long-term. All right, yes. Warren, valuations are important indeed.
So I think, when someone says to me, what do you expect for the year ahead or for the next few years from the stock market, whether it's in South Africa or international, the first thing I do is I go and look at the valuation of the market. In other words, I'm not looking at that index level of 53,000 in South Africa. What I'm looking at is how much money are you paying as a price for the profits that these companies are generating in our stock exchange, and that's really the jargon for that is the price earnings ratio. And at the moment, it's about a price earnings ratio of 16, which is actually not far off its long-term fair value. And when valuations are at these levels, we expect to get about 12% a year for the next 5 years. And so that's what I'm expecting from the JSE. And so that's kind of your financial gravity. And when valuations are expensive, then you would expect the returns to be low.
Yeah.
And when they're very cheap, then you expect the returns to be high. So at the moment, the gravity is kind of neutral, which means we can fly for a while.
Okay. All right. That's important. Right. Something big. I love your next point. Something big and unexpected will happen. We're not going to be hit by a meteorite.
I really hope not. But I think that's the point. The more people I talk to in South Africa at the moment, the more convinced I am that we're kind of overly pessimistic about the prospects for the economy. About the prospects for growth from investments, and every single year in markets, something big and unexpected does happen. But the trick here is it could be really positive and it could be really negative. And I think we've had so many big negative events happen in our history in the last 2 years that we've almost been conditioned just to think that big surprises are only negative, and I don't think that's really rational either. It doesn't take a heck of a lot for our confidence as investors to be swung into the positive, and it could be something like really kind of rational and sensible resolution to the whole land expropriation issue. It could be that we see the government take proper steps to sort out the state-owned enterprises, and either of those two events or any other multitude of unpredicted events could just catch investors who are really negative now by surprise, and suddenly we see a big jump in markets. And those who were sitting on the sidelines, being overly pessimistic with too much money in cash, get caught short and they miss out on the big bounce in markets that could happen.
Yeah, stay in the game. All right, your next point. Someone is going to brag about their performance in 2018. It always happens that way. You get the big mouths.
I love it. Whenever the stock market has a negative year, there'll be one or other random fund manager or fund management company that'll phone up their public relations agency and say, you know what, I had a cracking year when everyone else was down. Get me out there and get me some press and give me as many interviews as I can. And suddenly, the smart Alex fund manager will be out there saying, I had a really brilliant performance, you should be following me. And they'll, if they're really cocky, they'll be giving predictions for the year ahead and talking about how amazing they are. And what's really interesting to me is, I've only been doing this for 22 years now, and I follow these fund managers, and they're the really good ones that have got a great track record over 10, 20, 30 years. When they've had a good year, they're incredibly quiet. They just remain humble. Yeah. They don't get a lot of, they don't seek a lot of press, even if they're being asked for comment. But it's amazing to watch them, because when the markets have been tough, those are the fund managers that get out in the press and start talking about why investors should remain invested, why they should be patient, because they know that patient investors, after a lousy year, will get the reward from good fund managers. But they certainly don't go and brag about their performance after one good year, because for me, 1 year is such a short period of time that it's impossible to tell whether a fund manager who had good performance was simply lucky and kind of flipped the coin and called heads correctly, or if they really have skill. But if they do it for 10 years and they're successful after 10 years, by all means, go out and brag about it. But don't listen to those fund managers who are bragging about one great year. I think that's just, you can't tell. And therefore, rather keep quiet about great performance fund managers and do it when you've had 10 years of great performance.
Yeah. Your last point actually goes with this SMS I've just received. It goes, hi, I've traded Forex with a certain company as a beginner for 2 weeks now. I've lost all my capital. They even pressurized me to take a loan. What can I do? That doesn't sound good.
No, I think, that's a really sad story, and it's amazing how many people get caught. For the whole of 2017, it was all about trading Bitcoin. There were companies that were sprouting up and telling people that, they should give up their jobs and cash in their pensions and start trading Bitcoin because it was a certainty to make them billionaires in weeks, and the Forex trading companies are doing the same. And I think, just to be clear, these aren't companies that are telling you that they'll help you buy dollars or buy pounds with your rand. These are companies that are saying buy and sell your dollars and pounds versus rands on a continuous basis, and we'll make you millionaires. And it's rubbish. These are things that we've seen over decades. And if there was such a secret and easy formula to trade any kind of asset, whether it was shares or forex. These guys wouldn't be telling anyone how to do it. They'd be doing it for themselves and making billions and really keeping their secret formula to themselves. So it tells you there is no secret formula. That what they're doing is they're selling you a course and they're hoping that you'll trade through them, so they'll make some brokerage. But actually, I'm afraid that it's a sad story that repeats itself over and over again. And unfortunately, there is nothing you can do. You have to develop a long-term strategy for yourself about how to invest. Develop a proper asset allocation with how much you should have in shares, how much you should have in listed property, in cash and bonds, and then stick to your long-term strategy. But really, short-term trading things like this, I'm afraid, is just a great way to lose money, as that SMS is just showing.
Yeah, and get your game plan right. That's your final point, and you're so correct there.
Yeah, I think the big things here are, don't worry about 1 year returns on the stock market. Decide how much you need in shares, and it'll be based on your age. It'll be based on what your long-term investment objectives are, and then you decide how much you put in shares. And the same with any other of the big investment decisions. For example, how much you should have overseas. Don't worry about the fact that the rand might be strong or weak today. You need to decide, should you have a quarter of your assets overseas or half or whatever the deal is, but don't base it on what you think the politics are going to do next week or next year. That's a really, kind of a too short a time frame to make big investment decisions. You've got to set your game plan for your situation and then make the decisions around that. Don't worry about what's going on in the news this week, because it's just not going to help you.
Yeah, quite right. Financial advisor at Galileo Capital, Warren Ingram. Great to have you on the Money Show, and we'll see you soon.
Thank you, sir.